Hello, chart watchers, and welcome to this Tuesday, January 29th, 2019 Market Watchers Live show with your host, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, let's take a look at the action. We do have a bifurcated market this morning. The Dow Jones Industrial Average currently up 88 points. The S&P 500, though, down 4. The Nasdaq down 52, clearly an underperformer today on a relative basis. Russell 2000 mostly flat, up 1 point. 10-year Treasury yield continues to consolidate between 2.7 and 2.8%, currently down 2 basis points today to 2.73%. Volatility index continuing to struggle at the 20-day moving average. It is up slightly today, back up above 19. In response probably to some weakness that we're seeing in technology and communication services stocks. Industrials, however, trying to make a breakout. We do have a double top here, just about the 70 area. We're trying to get through that. That would be bullish, at least in one area of the market, if we can do so. Communication services, I mentioned, down just a little bit more than 1% today. And testing, if you go back to the January lows here, around 43.5, the XLC is right on that support level. So a breakdown there would not be good. This is one of the more influential, aggressive areas of the market. We don't want to see that support level break. Technology also having a rough day today, down 1%, close to the lows that we saw about a little over a week ago, around the 64 level. We'll see if that holds. Broadline retailers putting some pressure on equities today. Got the broadline retail index down around that 1700 level. And again, you can see going back over the past 2 to 3 weeks, that area has been very important from a support standpoint. We'll see if that holds. Amazon, one of the big reasons why, and you can see Amazon currently down at 1600, and that is where we have been bouncing in January. So you'll want to watch that level closely. Software within the technology space also having a rough day. I know Microsoft was one of the worst performers in the Dow. We'll see whether or not it can hold its rising moving average, but clearly it is at about a 2-week low in software, and that has been one of the leaders in the market. So, Erin, I was looking earlier, I think when I left, or when we ended the show last Wednesday, which was my last show, I think the Nasdaq was almost exactly where it is right now as we begin the next. So I know there's been a lot of up and down, but over the past few days, essentially, we've gone almost nowhere.
Yes, it's, the volatility we have, it just seems that it's being whipped back and forth. But yes, it is interesting that after all of that, you came back and there you go. Nothing's really changed, has it?
No, I think everyone was just waiting for me to get back. It's like,
absolutely.
Okay, we'll just put everything on hold until Tom gets back on Tuesday. But appreciate that.
Mm-hmm.
But yeah, I mean, market's kind of interesting. The volatility index, even though, it's not that 25, 30, 35 level that we saw, it has stubbornly refused to go down below that 16, 17 support area that tends to hold during bear markets. So I don't think the bulls are out of the woods. We've seen a lot of resiliency, but I don't think the bulls are out of the woods just yet.
Oh, no.
And
I still am a bear. You know that. I'm still, yeah.
Nothing changed while I was gone?
No, my stance hasn't changed really. No, not at all.
I've been pretty
that has stayed the same as well.
Yeah, I've been pretty impressed by the bulls' resiliency. I really have, but I don't think that the key area has yet been cleared. So this back and forth now, it's almost been like a battleground here on the S&P 500 as it gets up close to that 2670, 2675 area. I think that's the 20-week moving average. And I'm going to go over some of those charts and show how we're hovering just beneath those key levels. So we'll see. But there's still a lot of work to do on both sides, on the bear and the bull side, to try to gain control of the market.
Absolutely. All right. Well, what's coming up this week? Dr. Alexander Elder will be with us tomorrow. Can't wait to talk to him again. On the 31st, we will have our February seasonality report. Tom will let you know what to expect in February. Yeah, it happens to be my birthday that day, too. February 1st, we've got Mary Ellen coming back for what's hot and what's not. And Tom, I was thinking about it, and I kind of remember, I think it was on my birthday, there was the blood moon, and then on February 1st, I think that was the day the market took its first deep dive, right around my birthday. So hopefully that doesn't happen this time, but we'll see.
I think also, we've had your dad on your birthday and maybe on his birthday as well. He seems to show up here around birthday time. So I'm still thinking he's going to walk through one of the doors here shortly.
Well, we do have him now on the Decision Point show every Friday. I've talked him into doing that. So, all right, but let's get moving here. Building blocks of technical analysis, part 2. That's what I'm going to be doing today, building on what we did in part 1. First symbol will be booking holdings, BK and G. And then Tom's going to finish off by giving you a scooter report. So away we go, technical news and headlines.
All right. Well, first thing I guess we should mention, the FOMC meeting has begun. So that started today. We will get an FOMC announcement tomorrow at 2 p.m. And of course, you know, the Fed's kind of been in the spotlight. I don't know. They're almost like NFL referees. You know, you don't really want to hear from them unless you absolutely have to. Kind of ruin the parade sometimes. But anyway, there is a big FOMC announcement coming out tomorrow at 2 p.m. We'll see what they have to say and what they're, maybe what 2019 holds in store in terms of interest rates. Hopefully traders don't get too upset by what they have to say. Anyhow, out this morning, November Case-Shiller Home Price Index rose 0.3%, just slightly below the 0.4 expected. January Consumer Confidence 120 versus 124.3 came in a little bit low. And then the December Consumer Confidence was revised lower, 126.6 versus 128.1. So kind of a double dose of bad news there with consumer confidence. And as I mentioned, the FOMC announcement tomorrow at 2 p.m. We got a lot going on here over the next few days between the ADP employment report tomorrow, the FOMC announcement Wednesday. Of course, we got jobs report, the non-farm payrolls coming out on Friday. And that report last month floored me, the fact that jobs were so strong to open up January. And I think that helped to fuel the push to the upside. You got to wonder what might happen if jobs come in a little less than expected. So going to want to stay tuned for sure with all of the happenings and events coming out later in the week. Okay, let's take a look at the 10-year Treasury yield based on that economic news. And you can see currently the 10-year Treasury yield is down today. It's down about 2 basis points, 2.72%. And the 270 to 280 range that I talked about, you can see the high that was established coming off of that early January low. We made it all the way back up to 280, fell back, and has set this reaction low back at 2.70. And now we've just simply been consolidating sideways. The reason I think that this is important, if we go back and we look weekly, this area, if you go back here in March, early April, and then again in May, this mid-270s area had been support in the past. We went just below it, came back up above it, and now we're just sitting here right at about these prior lows. And you can go back and look at the double top, 2016, 2017, at about the 2.60% area. We broke out above that in 2018, and we have been holding. So this is an area, I think, for the 10-year Treasury yield where it really needs to hold for that longer-term secular bull market that we've talked about. If the economy is going to strengthen and the bull market's going to continue, we really want to see the 10-year Treasury yield start to move higher again, because that would indicate more money rotating away from Treasuries. That would help to fuel the stock market rise. So anyway, still something we got to keep an eye on. And with all the economic reports coming out, this is going to be a big week. Technically, with the S&P and all the major indices, we're at a key area as well after this rally off the December 26th low. So a lot going on technically, a lot going on fundamentally, economically, and of course, all the earnings reports that are going to be coming out. I mean, that's going to it's going to be the floodgates opening here over the next couple of weeks, and we got some big ones out tonight. So let's go ahead and talk about earnings. Earlier today, we had Pfizer, Verizon, SAP, 3M, Lockheed Martin, Danaher, Biogen. These are just to name several. I mean, there were a ton of earnings reports coming out this morning. After the bell tonight, you can see Apple, Amgen, Stryker, CNI, Illumina, eBay, Advanced Micro. The list goes on and on. But these are going to be fairly influential, especially in the technology area. So we're going to want to keep an eye on that. Apple, of course, already warned back at the beginning of beginning of January. So I would expect that they are going to come in no worse than what they had forecast. I'm sure they tend to be very conservative. They don't miss their forecast very often. I'd be really surprised if they warned in January, came back 3 weeks later and missed those lowered numbers. So I would be looking for maybe a slight beat on Apple. I just don't know whether or not that'll be enough to spur the market. We'll have to watch and see the reaction later this evening and into the market tomorrow. Okay, let's take a look at the S&P 500. I'm going to show you on a weekly chart first. We'll get into some of these earnings reports in just a minute. But let's take a look at the S&P 500. Here is one of the problems. When you're in a downtrending market and you've got a very weak PPO, now you can see the PPO has been strengthening, but I'm talking about at the lows. When you get a new low like we had in December and the PPO is pointing straight down, there's no positive divergence, a lot of times the 20-period EMA will hold as resistance. And that's what we're looking at right now. You can see the overhead 20-week EMA. We got right up to it the last couple of weeks. Now we're starting to move lower. Honestly, I wouldn't want to lose 2,600 back to the downside. That has been holding over these past couple of weeks. If we go back down below 2,600, I think that will encourage more shorting, more selling, and that could begin another leg to the downside, perhaps even to go back down and test that prior low. So short term, I want to kind of watch that level. Now, if we go into a daily chart on the S&P, you will see that the rising 20-day moving average currently is at 2610. The 50-day moving average is at 2610. So not only on that weekly chart would we be losing some of this price support that I just talked about, but then you're looking at daily charts losing key moving averages. So I think 2,600 is going to be a key area to watch for the market to see whether or not we can continue to hold. Earlier today, you can see the S&P got to 2631. So we got a little bit of room to the downside, but still, this is going to be a critical week or maybe a couple weeks for the U.S. equity markets. I wanted to pull up the NDX, the Nasdaq 100, because on a weekly chart, you can see it too. We went up to that 20-week moving average. And by the way, you can also draw a trend line from the high at the beginning of October, the high at the beginning of December, and that intersects right where we are now. So you've got trend line resistance, you got 20-week moving average, and it looks like we're starting to roll back over. And I would view that to be somewhat of a negative. Let's go back to that S&P 500 chart for just a second. Because not only right now, short term, we're holding above that 20-day, and the 20-day is trying to cross over the 50-day. So we're getting our first golden cross since we had the death cross back in October. So all of that's good, but just keep in mind the weekly chart is bearish. So if the daily chart starts to break down, I think you've really got to pay attention to that longer term weekly chart, which remains bearish as well. On an hourly chart, so we're going to condense it even further. One of the problems in the market right now is yesterday's move went below the 20-day moving average. We came up above it at the close, or actually at the open today, just briefly, and then right back down below. Now we're just kind of sitting almost right on it, 2642. You can see that the 20-day moving average, 20-hour and 50-hour moving averages are almost identical. Same thing with the daily charts. So these levels are going to prove rather important by, well, this one maybe by the end of the day. We'll see. The Nasdaq 100, though, when you look at it, we're rising coming up off the earlier low today, but now appears like we're starting to set this the stage here for lower lows and lower highs. And I believe 6,600, the test here that we saw back on January 23rd, which was last Wednesday, I think that needs to hold to the downside. We got down as low as 66.13 today. I wouldn't want to see that support area break. We had almost equal highs. We've got this double bottom essentially here printed on the 22nd and 23rd. I think if we go back down and go through that, that's going to encourage some sellers as well. All right, the Nasdaq 100, why is it performing so badly? Well, let's take a look at the Fang, because that is a big part of what's going on. First, we'll start with Facebook. Facebook, you can see, holding on to its 20-day moving average. A break below that level, 144.16, would be the first break on Facebook in the last few weeks. So something definitely to keep an eye on. Also, keep in mind that Facebook on a weekly basis just pierced its 20-week moving average barely, and now we're right back down beneath it. So if we go back down and we lose the moving averages on our daily chart, given the look on this weekly chart in my opinion, that would not be good. Apple, they report after the bell, way below the 20-week moving average. Stock has not really had much of a recovery. We did go back up, I think, and fill the gap that we saw from the earnings move lower. But really getting back through 160 has been difficult so far. Amazon having a rough day. Amazon, though, had climbed above its 20-week moving average. It is now back down below. And as I mentioned at the top of the show, January, we've been holding this 1600 level. I'm going to go into a daily chart here on Amazon. But here are the lows coming across. Last two lows have held right around 1600. We went as low as 1593, but we're back above 1600 right now. Also bounced off that 50-day moving average. All right, how about Netflix? Netflix has been the best performer technically in the group. Had a huge move in early January. We pulled back, held above the 20-day moving average, trying to bounce off of it. We are down about 1.4% today, but so far, I think as long as we hold on to about 320, we're okay with Netflix. And then finally, Google. Google, the rally's been kind of slight here, I think on a percentage basis, probably not doing as well as some others. But it is so far trying to hang on to that 20-day moving average. This is another one recently about, I don't know, 1065 has been pretty good support. We could maybe go back to that January 14th low. Let's just say 1050. I wouldn't want to see Google lose 1050. That would be below the mid-January low and also these recent short-term moving averages, the 20-day and the 50-day. So watch Google. That's just a quick update on those 5 Fang stocks. Now I want to talk about some earnings before Erin gets into her workshop. Let's start with some of the big ones. PFE, which is Pfizer. They beat top line, beat bottom line, but they guided their fiscal year 19 earnings per share lower. Stock gap down, but is rallying back. That's always a good sign. But can we hold it? Because yesterday on big volume, we did break down. So if we leave a tail, go back down toward the low end today, I think that's bearish. Otherwise, this is a nice reversing bullish engulfing candle in play so far. Verizon came out. They missed on their top line, beat on their bottom line, mixed guidance. The stock gap's lower, holds on to the December low. That's a key low in my opinion. 52 and a half right in here, I think is going to be really, really big support for Verizon. So we'll keep an eye on that. SAP beat on the top line, missed on the bottom line. The stock, I don't know, in my opinion, struggling. I'd like to see it get through this gap resistance, which is up at about 108, 108.50. We tested it yesterday. Good volume, but we left that tail to the upside. And now with earnings, the stock trading back down. Still got some work to do here on SAP. 3M beat top line, beat bottom line, guided fiscal year EPS lower. That is a common theme, by the way. A lot of stocks guiding earnings per share lower for fiscal year 19. But the market reaction, bullish so far. If we can hold a close over, say, 196, 197, to me, that's bullish. If we go back down and close below, say, 195 and a half, 196, leave that long tail, false breakout, I think that would be a bearish candle. So let's see how we finish. Lockheed Martin, LMT bouncing off the 20-day moving average. They did beat on the top line. They matched estimates, bottom line, $4.39. They too guided fiscal year 19 earnings per share lower. Danaher, DHR, guided in line. That's actually kind of a positive, but they did beat top line, bottom line, and then that inline guidance. Stock was up earlier, but has reversed. I'm just looking at this sideways consolidation. Biogen, BIIB, they guided fiscal year 19 higher, beat top line, beat bottom line, got a nice little test on the 20-day and trying to bounce off of it. With the strong report, I'd be surprised to see it close back below the 20-day, but we do want to keep an eye on technicals. A couple of others of note, Sanmina, SANM. They did beat top line, beat bottom line. They guided Q2 revenues and earnings per share higher. Nice response here. TVTY, they guided Q4 revenues lower. But looking at the chart, you probably should have been assuming things weren't very good there based on how the stock's been trading. Whirlpool, kind of all over the place. They missed on the top line, beat easily on the bottom line, guided lower, opened down, but has exploded back to the upside on heavy volume. This one, need to see where it closes. Okay, we got a bunch more, but I will say this. I put all of the earnings I looked at on an Excel spreadsheet, and I've got green when companies beat or guide higher, and I have red where they miss or guide lower. And there's a lot more red than I'm used to seeing. So the market right now is dealing with some earnings reports that are not that great. Guidance has not been that great. And so far, the market's holding up pretty good. So that's the good news. The bad news is if we start to break down on some of these short-term daily support levels, be careful, because the weekly chart still remains pretty bearish. All right, Erin, I know everybody enjoyed your last workshop on different patterns. I know you're going to add to it today. What do you got?
Yes, so I did the building blocks of technical analysis the last time we went. And let's go ahead and get this going. Okay, make sure everything's good. Everything looks good. If anything doesn't, tell me. I'm going to be doing everything off of this PowerPoint. So when I did the building blocks of technical analysis, it's been running, I know, on StockCharts TV. I did it December 18th. So it's been on StockCharts TV, the live version, a couple of times. But you can also go to the StockCharts YouTube channel and look up building blocks of technical analysis, and it'll bring up part 1. So that you can, go through that. But basically what we did in part 1, we looked at price bars and time frames, so how a candlestick and an OHLC bar, it works, what's intermediate term, what's not. Excuse me, let's go back. We looked at support, resistance, and how to draw trend lines. We went over the different moving averages, and I talked about the basic indicators, the moving averages and momentum. And then I got started on price patterns, but I wasn't able to really get into that. So here's what I'm going to do today. First of all, I'm going to do just a quick technical analysis lingo for beginners out there. And then I'm going to go over divergences in a kind of I'll be looking at it a little differently. It's going to be, I did a very complex divergence, convergence workshop before. So I'm not going to go too in depth because you could look up my divergences web workshop as well. I'm going to talk briefly about the VIX and breadth, and then we will look at some of those basic chart patterns. So let's go ahead and get started because we do have a lot to cover right now. All right. So here's some of the lingo that we use a lot, I know. Outperformance and benchmarks. Outperformance, usually whether you've outperformed when you've compared to some sort of benchmark. It could be, I know when Julius does his and he looks at a bunch, or if maybe you're looking at your portfolio, you're looking at simply, which ones are doing better than the others? Am I, on the positive side? Am I on the negative side? So that's sort of an outperformance thought. But usually we use a benchmark, and the S&P is the benchmark. And a benchmark means you're making a comparison between what you are looking at, the stock or whatever it is, in relation to the S&P. Did it do better? Did it do worse? And of course, all of the brokers, all of us, out in market timing, everyone, we're trying to beat the S&P. We want to do better than the S&P. So that's what a benchmark is. All right, the symbols, I know some people have asked about, what is the dollar sign and what are the exclamation point symbols? Dollar signs give you indexes generally, and the industry groups. Like we always look at the Dow Jones US, software or, trucking or whatever it is. Those are going to be with dollar signs. And then the exclamation point symbols that you'll find, those actually migrated from decision point. So it is indicators. It'll give you an indicator set, like new highs, new lows, or sentiment up, down. That's going to be preceded by an exclamation point. So that's the difference, at least on stock charts, with how we use the dollar sign and the exclamation point. If there isn't either, then it's an ETF, stock, or mutual fund. Buy and sell signals. This one is a little tricky in that, market timers, we use it all the time. because that's our benchmark. We have to see, are we good on our signal for the buy, and how did that do versus a sell? And then Decision Point also has neutral signals. And so I'll go into that in a little bit. Sell into strength. I know we've been saying that a lot lately, Tom. You know, basically, if you're in a bear market situation, which I believe we are right now, if you haven't divested from certain you know, issues that you have, if you haven't divested out of certain stocks or certain industries, but you're feeling that it's bearish and they're probably going to, you know, suffer because of what's happening in the overall market, or if it's in the Nasdaq 100, so you know it might suffer because, you know, Apple's not going to be doing well. So, you know, so selling into strength means that when you're in that bear market, it's not going to go down every day. So when it does go up, like we really have been experiencing now since well, the end of December, you know, since then we've been making this move to the upside. I still believe we are in a bear market, so take advantage. You sell into strength, you take advantage of that bump to the upside and divest before it goes down into weakness. So that's what sell into strength means. Divergence and convergence, I will go over that. That's really an analysis technique that we use to determine whether a stock or ETF or index or industry, you know, what the comparison is between an indicator and the price of what's going on. And then we measure whether it's diverging or converging. And again, I'll show you some examples shortly. And then we'll talk about VIX and breadth. Some of you read my article before, and one of our viewers, I wish I could give him credit because I don't know. I don't know who exactly it was, but he had mentioned when I go over my VIX and breadth chart, I always talk about the VIX and breadth, and it sounds like VIX and breadth. So anyway, so we'll look at the VIX and breadth and kind of what those mean and how you can use those. All right, so here are those signals. Remember, I was talking about buy and sell signals. So what we have here are the various kinds of signals. Now, I think the easiest way to look at what a buy and sell signal is for Decision Point is just using the PMO. And you can use this with the MACD, you can use it with however you do it. And you know, so your signals are sell signals, if you're looking at the PMO, are downside crossovers, you know, move below the signal line. That's the way we call it, the signal line. It tells us what the signal currently is based on where the indicator itself is. And of course, the signal line is simply a moving average. So when you look at these downside crossovers of the signal line, that's considered a sell signal. And of course, the upside crossovers are considered a buy signal. Now, I brought neutral into the game here because in Decision Point, we follow moving average crossovers. And that's how we come up with our short-term, intermediate term, and long-term buy, sell, and neutral signals. So the easy one is the 50-day EMA and the 200-day EMA. An upside crossover is buy, and a downside crossover is always a sell. So the long-term trend model, you're only going to get a buy or a sell. Now, unfortunately, now when you go to the short term and the intermediate term trend models, now you have to add in the neutral signals. And the neutral signals are simply, you know how I talk about with Decision Point, if a stock has the 50-day EMA above its 200-day, that it's in a bull market configuration. That's why we have a neutral signal, because if our negative crossover of the 20 and 50-day EMAs, if that occurs above the 200-day EMA, we make it a neutral signal because you're still in a bull market configuration. And so you don't, you know, maybe you don't want to. Some of our more aggressive Decision Point followers use a neutral like a sell. But for us, if you're in a bull market configuration, your expectations should be more to the upside. So we go with more of a neutral, which means fully hedged or in cash. Now, obviously, you're not going to have your whole account in cash necessarily or fully hedged. But when you're looking at that stock, maybe you want to pick something from an opposite industry group or something that might travel differently to hedge against the fact you got this neutral signal. So those are buy and sell signals. So let's look quickly at divergences. There's the positive divergence. So actually, let me go back just quickly. So here are the different divergences: positive divergence, and then right piggybacking on that is the bullish confirmation. There's the negative divergence. Piggybacking off of that is the bearish confirmation. And then, of course, we get to confuse things completely by adding reverse divergences. So I'll give you a look at this. And I did do that workshop on divergences. Highly recommend you go check it out if you want to get a little bit more in depth about what I'm talking about. So with divergences, positive and negative, you start with the indicator because you're looking at rising bottoms and declining tops. Remember, there's no rising tops line and there's no declining bottoms line. I mean, you could certainly mark that, but it's not the classical. Hey, why don't we keep going back? Okay. So I start with the indicator and I have a higher high on the bottoms, rising bottoms on the indicator, but on price I have declining bottoms. So that's considered a positive divergence. Momentum, say this is a momentum indicator. Momentum is still building even though it moved lower. And now you've got that deep dip in price, but overall the momentum is still to the upside. So that's considered a positive divergence. You should expect a bullish move or a rally in this case. So here you go. So there's well, that's not very good. That's the confirmations. So negative divergence is starting with the indicator again. Now you're looking at declining tops and then you compare that to price and they're rising, right? So with declining indicator tops, like think about it as the momentum, even though the price is starting to go up, the momentum is slowing. And so that is a negative divergence. Momentum is slowing, yet price is rising against that. And so that tells you that there's some problems with this rally, that you should expect some weakness. And that's why you look at this as a bearish divergence. All right, and then there are the confirmations. And the confirmations are pretty simple in that, we used rising bottoms on the indicator, right? And we used declining tops on the indicator. Well, if the price is going the same way as the indicator, then that's a bullish confirmation. If they're both moving up and higher, that's bullish. If they're both the declining tops, that's a bearish confirmation. So that's just telling you that the indicator is in line with price is in line with the indicator, and so you can expect a continuation. Reverse divergences, the best way I can explain is you start with the price or the upper window, and then you draw your rising bottoms and declining tops on price, and then you compare those to the indicator. So here's an example. So we started with price because remember, there's a rising bottoms and there's a declining tops. Those are the two things we look at in technical analysis. So if you're starting with price and you're looking for a confirmation, or a divergence, a reverse divergence, you start with price. So we have the rising bottoms, and then you look at the bottoms on the indicator. So we have rising bottoms on price and declining bottoms on the indicator. And so typically that's considered a negative reverse divergence. The opposite would be declining tops, but you're seeing rising tops on the indicator. So the indicator is rising despite the fact that price is moving down, and that's considered a positive reverse divergence. So again, it's the difference is that you're comparing you start with the price and look for rising bottoms and declining tops. All right, VIX and breadth. So the VIX basically measures the volatility of the market. It's like our fear gauge. It tells us it's the options market. It makes a comparison, and we can tell the implied volatility, and we use that to measure the overall volatility. Breadth is simply compares the number of issues traded with the number of issues listed for trading. So you have a closed universe, say of the S&P 500, and we look at advancing issues and declining issues. So which ones were advancing and which ones were declining. And then we use the advance minus declines as another indicator. So here is, there's the advancing declining issues, and then also new highs and new lows. Those are all the indicators we use with breadth. I'm sure there's more, but those are the typical ones that we look at. All right, so let's make a comparison. All 4 of those are on this chart, so it's a perfect example. This is my climactic indicators chart. So the breadth I look at and the VIX as very, very short term. And it helps me with looking for initiations and exhaustions. Okay, so let's start with the top one here. New highs, new lows. So in this case, there were only 13 new highs in the S&P 500 on that day. And then when we look at the advances minus declines, it's all the advancing issues minus all the declining issues. So if you get a negative number, that means more we're declining than we're advancing. And so we make a comparison of that. And I do also the one for volume, because you can do that as well to look at the breadth. So in this case, I'm not going to give you a whole reading of this chart, but we're seeing that in this, you can see that overall, we were looking at breadth numbers, the advanced declines moving downward, and that's what I was looking at downward here. We really for a while weren't seeing any new lows or new highs, but that's because we had so many new lows. You have so many that are way down there. It'll take them a long time before they can get back up to make a new high. So that's why we didn't have any there like we would normally see. And there is the VIX, and you see us talk about it all the time. The lower numbers mean that people aren't as fearful, and the higher numbers mean that people are very fearful. And so what we do is we look at where it travels, and the wider this Bollinger Band is, that tells you the more volatile the market is. I mean, I think that we all knew when we were going through these times and continue to go through these times that we're having, it's quite volatile. So I look at this is an inverse scale, because if everybody's very, very comfortable and you've got puncture on that upper Bollinger Band, people are very comfortable, that's usually when you get the reversal in the short term. And vice versa, when people are very, very fearful and very bearish, that's about the time you need to start looking for a reversal to the upside. So that's why I invert it that way. All right, so I want to get into some of the chart patterns, and I did do a chart patterns workshop that I recommend you go take a look at. And I don't know why this is being kind of ugly, but I'll go over the ascending and the symmetrical triangles. I'll look at a bull flag. We'll look at a descending wedge. We'll look at the double and triple bottom and rectangles, as well as I don't have it in here, but a head and shoulders. We'll look at that as well. And like I said, that was covered in Trading Chart Patterns, and I did that workshop in July. And I probably am going to do, I think that might have been the first one, and I think I did a 2.0. So just look that up on YouTube, and you should be able to find those and get even more detailed than what I'm going to go over now. But this is, I'm looking at building blocks, and this was one of the first things I learned after learning support and resistance and trend lines and all of that. One of the things my dad, when he was helping move me and teach me along the way as from teenager on up, he showed me very early on was the chart patterns. And I got Thomas Bulkowski's Encyclopedia of Chart Patterns, a super fat book. Big, look, it is like an encyclopedia from back in the day. I mean, he's done tests on them. He talks about all different kinds that, we generally don't look at, scallops, and I mean, just some very strange ones. But he's the guy to look up, Thomas Bulkowski. We also had the visual guide to chart patterns in the StockCharts bookstore, also really good for covering chart patterns. So those are the bullish chart patterns. So let's go ahead and we'll look at some of those. So the first one I'm going to look at is the ascending triangle. And this one can be a continuation pattern or a reversal pattern. Well, what does that mean? Continuation means you're going to continue in the same trend you were already in. A reversal pattern means that when you see the pattern, you should expect the trend to be reversing if it executes. Now, in this case, like I said, with the ascending triangle, it can be either of them. So it doesn't have to occur at a certain place or a certain time. And the idea is you have rising bottoms, yet you still have this overhead resistance. And so the prices are getting higher and higher. And what we look for is that burst to the upside, and that executes that ascending triangle. It's bullish, so the expectation is an upside move. Now, remember what I've been telling everybody, though, if you have that 50-day EMA below the 200-day EMA, you're in a bear market configuration. And what do? We expect the bearish outcome over the bullish outcome. So had we been in a bear market situation here and this came up, my expectation would not necessarily be the breakout to the upside, because I'm in a bearish market. There's a certain gravity, that pulls down on price because of that. And so I wouldn't expect to see it break out. I would expect to see it break down in a bear market configuration. The symmetrical triangle is typically a continuation pattern. It can break in either direction, but typically it goes into, it just continues the trend. But it's a time of indecision. Nobody can really grapple and grab the market. And it just gets to a point and either the bears win or the bulls win. So the symmetrical triangle is just interesting in knowing that there's, indecision, there's people are, there's pushing and pulling. And so they're interesting to find, and then it can give you a sense of what's going on in the market in general. Now look at this, the 50 was below the 200, and a symmetrical triangle can actually go in either direction, but the 50 is below the 200. So what would we have expected? We would expect it to break down, and sure enough, in this case, it did. All right, the bull flag, and I've gone over this a lot, so I'm just going to really do this, the flags quickly. So it looks very much like a flag. You get a flagpole, and then you'll either get a little declining trend channel, maybe even a little bit of a rising one, or you'll see that pennant, that symmetrical triangle on the end of it. And these are continuation patterns, so they should occur in an upward move. If you're getting them somehow, I don't know, and you're in a declining trend, it wouldn't be as accurate. So once you see these, it's a measured chart pattern, so you can measure the length of that flagpole to give you a minimum upside target. But anyway, I'm not going to go into detail there because I know I covered that pretty deeply in both the building blocks previously and the chart pattern workshop before. This is the descending wedge. This is a positive chart pattern. When you see prices coming together here as they move down, that's a descending wedge. And so you're supposed to expect an upside breakout. And the 50 was above the 200. So my expectation would be that would have executed, and it did. Double bottom formations, the W's. I think this was the first one that I learned because it was so easy to spot. And you look for the two bottoms. These are reversal patterns. So these you should expect at the end of a downtrend. If you're getting them in the middle of an uptrend, it's not really as valid. So I wouldn't look at it that way. But you can see here we had that double bottom, and then you have the middle of the W, and that becomes your confirmation line or neckline. I use that because it's what I use all the time for head and shoulders, but the confirmation is right there at the middle of the W. The expectation is an upside breakout. Now the 50 was well below the 200. So in all honesty, when we got here, while I was looking for a possible breakout, we were still in a deeply, it was in a bear market configuration back here because the 50 was below the 200. However, divergences, remember? Rising bottoms on the indicator and declining bottoms, almost even bottoms on price, that's a positive divergence. So you add in the fact that you had a bullish chart pattern as well as a positive divergence. I would be willing to forgive the fact that the 50 is that far below the 200. And you do the measured move when it breaks through. The amount that it moved up, that's the amount you should expect it to move up after it's executed. And typically it will reach that. And sometimes, interestingly enough, it'll land right there on support and resistance. All right, triple bottoms, pretty much the same idea, only your confirmation line is over those two peaks that are formed by having a triple bottom. And just like the double bottom, works the same way. You can do the measurement to get your upside target. And the rectangle, pretty boring pattern. Basically, it's a trading channel. You're moving back and forth, up and down, obviously within the channel. Typically, that shows you if you're on, you've been on this uptrend and then you start to just consolidate. It could be a chance for prices to take a break, and now you can get that upside breakout. But it could also break down there too. So it could be a reversal pattern. And you'll watch, usually volume will start to dwindle for the beginning into the end of that pattern, and it'll rise if we're going to get a breakout at the end, and it'll start to, if we're going to get a breakdown, you'll really see volume start to peter out. All right, bearish chart patterns. Let's go through these. Descending triangle, rising wedge, bear flag, double and triple tops, head and shoulders. Oh, well, we'll do the bear flag. All right, so let's start with the descending triangle, this bearish pattern. Basically opposite of the ascending one. Flat bottom, declining top, and the expectation is a breakdown. It could be a continuation, as it was in this case, or a reversal. And we had, if you look, we had declining tops on the indicator, declining tops on price. That's a bearish confirmation. So I would have expected it to execute. Plus, we had the 50 below the 200. Ascending wedge. These are the opposite, of course, of the descending wedge, which is bearish, could be continuation or reversal. You should, though, expect a breakdown of these patterns. That's typically what you're going to see. In this case, I may have been a little, I would have probably, we failed at overhead resistance. This formed, so even though the 50 was above the 200, I would be looking for a breakdown just because we failed to continue on that rise. We didn't get that far above that previous top. And basically it hit it and then fell back down. And then you can see right after that, it started to break down below that channel, and then that was pretty much it. The reverse flag, pretty much just opposite the bull flag, looks very similar. And with flags, you kind of want, with the bear flag, you sort of want the flag to kind of be moving upward. And with the bull flag, you kind of want it to be moving downward. Bearish double top, similar to the double bottom, so I won't go over that too deeply. Triple top, same idea, just different, the opposite of the bull pattern. Head and shoulders, everybody talks about these a lot. Looks like a shoulder with that big head on the top there. And then this is the neckline. These are bearish patterns. The expectation is a breakdown, and they are reversal patterns. So, you're going to have I guess you might say a better expectation of the breakdown if it's a reversal. If this came in the middle of a decline, it's not a continuation pattern. So I just don't look at it as a valid pattern. Reverse head and shoulders, I didn't talk about those, but it's, of course, the opposite. And it's a bullish pattern. The expectation is a breakout above the neckline. All right, so our summary from part one, we went over those price bars, moving averages, basic indicators. So again, go ahead, look up building blocks of technical analysis on StockCharts YouTube channel, and it will come up and you can watch part one on your own. And this was part two. And that's what we covered. We looked at the lingo that we use a lot, divergences. I talked about the vixen breath, and we did look at those basic chart patterns. So that concludes my workshop. So why don't we bring up the poll and just see, I want to see, you know, where everybody is in their technical analysis studies. And there you go. We have a lot of quote unquote experts out there, Tom.
Been doing it a long time. That's awesome.
Yeah. Absolutely. And honestly, the less than 1 year folks, I know you're a small percentage, but welcome here. This is, I mean, you really are in the right place to start learning from stock charts, the blogs, all of that. And of course, watching us every morning is great too. 1 to 5, yeah, that was sort of my expectation that we'd probably have that in there, but I didn't honestly expect to have that many in the 10 plus category.
Yeah, I think when you add the 10 plus and then the 5 to 10 years, you got more than half our audience has been looking at technical analysis for more than 5 years. So I think that's awesome. You know, I think too, I'm assuming you've probably had better results in the market since you started using technical analysis than you did before. I'm guessing that's why you chose to get involved in technical analysis. And for those who are new to it, it's going to change the way you look at the market, no doubt.
Completely. It's, you know, for me as a math major, my master's is in information resource management. Technical analysis was an easy fit for me because the mathematics involved, the visuals that were involved, I just love it. So for me, it was easy to move into, and I probably got a little of that love from my dad's passion for it as I was growing up.
Yeah, I mean, my background, I'm a CPA, so I was in public accounting for more than 20 years before, you know, really getting into the stock market full time. And of course, I had a passion all along. I mean, I remember back in the 1980s, actually having these long accounting ledger sheets out, and I had all the Dow Jones components had their own little ledger, and I was actually charting. I was doing like bar charts. I didn't color in the candlestick charts, but I was doing bar charts on my own manually back in the, I would say probably early to mid 1980s. So, you know, coming to work with stock charts, I guess I started probably here 30 years after that. It's pretty amazing that that's where my career ended up heading. But
yeah,
isn't
it crazy? I mean, if you had asked me, you know, let's face it, when we graduated high school, which obviously is a long time ago, or college, what are you going to do? What is your, you know, what is your career going to be? This didn't even exist. What we do, really. I mean, TA existed, but blogging, broadcasting online, it would have been completely foreign. If somebody had talked to me about it, I would have been like, yeah, right, whatever. Sure.
It works. Yep. Yeah, come a long way from where we started for sure. This is, you know, when I was in public accounting, though, of course, I actually, even though technically management prepares financial statements and the notes to the financial statements, and auditors typically just audit them, because we were in a smaller firm, many of the companies that I dealt with didn't have huge accounting departments that could put together stuff like that. So we, in essence, put together the financial statements. And, you know, it's kind of interesting now having the perspective from the fundamental side, the accounting side, and then also having it from the technical side. I have said before, and I mean this with all my heart, I would give away those financial statements. I wouldn't care if I ever saw a financial statement. I can't even tell you when the last time I looked at a financial statement, other than going through the news maybe and getting earnings report, you know, getting the earnings versus the actual versus the estimate, that sort of thing that I get on a regular basis. I never physically pick up an earnings report and go in and start reading the notes to the financial statements. I mean, oh my gosh. First of all, the time involved would be crazy, and it wouldn't tell you anything that you didn't already know by looking at the charts, to be honest.
Absolutely.
So
absolutely.
Anyhow, all right, well, 10 and 10, what do we got for today?
All right, well, we'll start with the first one, which is booking. So we'll start. And then the second one will be the most popular in the chat room. So guys, go ahead and like the symbols that are already in there, and we'll get that one in.
All right, well, I looked at booking, and this is one thing I did, I think, last Wednesday. I just showed a volume by price, and all you have to do is go down here under the overlays, and that's one of your choices. If you click on this volume by price, it essentially just kind of helps you visualize where a lot of the activity takes place on a chart. And if you look across here, this is where the most volume has occurred, right in this range. I mean, let's just call it 1860 to 1910. But when you look across here, this is where you get a lot of action, both support to the downside and also you can see some resistance to the upside. So as booking climbs and gets up into this 1850 to 1900 area, you should at least be aware that this is where we have seen a lot of volume. So you're probably going to run into some sellers here. Now, I'm going to show you one other thing here on booking, and that's the seasonality. This is one of the strongest stocks in the market through the first 4 or 5 months of the year. January, February, March, April, and May. Look at those returns on average over the last 20 years. And look at the percentage chance February, March, and April going higher. So here we are on the cusp of moving into February. The 3 strongest months of the year for booking are coming up. And so I would just be aware of that, because when you look at the chart and you see it now back above the 20-day moving average, and these pullbacks are starting to hold on, technically the stock's looking pretty good to me. And knowing that the next 3 months are so bullish for the stock, as long as it stays above that 20-day moving average, I think you can own this one. And I marked a key area of resistance. Notice once you get past this 1900 area, the volume, in this area is not very great. So I would expect that if we get through 1850, 1900, we'll probably move up and test this overhead resistance at about 2000. And then you can see the overhead resistance between 2000 and 2100 picking up again. So it's just a different way to look at it. It's just another tool that you can use here at StockCharts.com to help you evaluate whether or not a position looks good, whether you want to be long, short, maybe sell into strength, which Erin talked about earlier. A lot of different things you can be thinking about, but that's just one more tool to use. So I like booking. I think this time of the year, I'm not going to argue with history when it's been so strong. The historical tendency has been so strong on the stock. I think you're going to make a run for 2000 sometime between now and the end of April, if not higher.
All righty. And looks like the most popular in the chat room, wow, it started to move around, is Gilead, G-I-L-D.
Oh, don't need that on the seasonality. I guess we could look at it, but Gilead making a breakout or trying to make a breakout. Volume's okay. I'd like to see it strengthen a little bit. This is kind of a short-term area of resistance. I think the bigger one is going to be this quadruple top or maybe quintuple top up at $72. That's where all the selling began at the beginning of December. So if we continue to make our way up there, I think you got to watch 72. So if I was in the stock, because it is trading more solidly above the 20-day moving average, I'm okay with it. But as it gets closer to 72, based on what I'm seeing here, as a short-term trader, I would be selling Gilead in the 71, 72 range as it approaches overhead resistance, and let somebody else hold it and see if it can get through. Because if you held it the last couple times, it was rising and got to 72, you'd have been pretty disappointed a week or a few weeks later. So I would continue to pay attention to that overhead resistance. I like Gilead, but I think it's got some work to do to get through $72.
All right. The next one I have for you is 3M, MMM.
Yeah, this one reported earnings. You can see that long tail. We talked about it earlier. It was up over 198. Now it's 197.37. I'm not going to like this stock if it fails to break out. And there are really 3 different candles on here that I think are worth watching. Here was one. You can see the volume picked up from the selling that began heading into that December 24th or 26th low. So that was about 196.5. And if you notice the last 2 tops, even the last one went up above 196.5, failed, and we went back down, tested the 20. So far, we're getting bullish tests of the 20. That's good news in the short term. But we've been continue to fail at trying to close over this 196.5 area. So if we leave a long tail up there and finish back down closer to the low of the day, I'm not going to like this, the look of this chart. And I think I mentioned earlier in their earnings report, 3M did guide fiscal year 19 earnings per share lower. So this could be a false breakout, and kind of a, with everybody buying this potential breakout, it could be a way market makers are allowing one of their institutional clients to sell a large position. So I don't like to see these false breakouts. We'll want to see how it closes today.
All right. Let's see. The next one I'm going to give you is China Mobile Limited, CHL.
Looks good. Really nice breakout. Look at the volume coming in to confirm. It's overbought. We saw RSI readings get up to about 70. So I'd like it on a pullback. But yeah, I mean, technically, what we've been looking at, and this kind of is a little different than the other charts. Now, we didn't quite get up and test it back in the end of November. But you can see we firmly established a resistance level at about $50 and say 50 cents or maybe $50.60. But we did manage to get above it on moderate volume. And after pulling back, you can see we've extended it to new highs with very, very strong volume. So I think the rising 20-day moving average, which is just below 51, and then this price support area, which I'm going to say is right at about $50.60, that should hold on a pullback. The closer it gets back down to that 50, 75, 51 area, the better I like it on a reward to risk basis. So I think CHL looks pretty good.
All right. Let's see. The next one I'll give to you is Auto Parts Dana Incorporated, DAN.
Strength definitely showing here, and overall, I think the overall market, this is where this kind of looks like what the market's been doing. It seems to be trying to run out of steam here. See how it keeps getting up about 1775 or so and then can't get through. There's two key areas. This, I believe, was earnings back on October 29th. It gapped up to about 1760, traded intraday to about 1840, it looks like, and then sold off and kept moving lower. So now I think this is the key area of resistance as we move up, and we're just kind of crawling into the lower end of it. So I personally would be a seller on Dana in this area up to about 1840. I don't think I'm as bearish longer term maybe as you, Erin, but I am in the same camp. I think that until the market can prove to me otherwise, I'm looking for it to roll over and move lower again. So when I look at stocks and I see overhead resistance like this, I assume that we're going to go back down until the market proves to me otherwise. So I'd be a seller of Dana in the 17.5 to 18.5 area.
All right. Let's see. The next one is going to be GLW, Corning Telecom Equipment.
Yep. They reported earnings yesterday or this morning, I believe. I thought I had written it down, but I don't see it here. But they did come out with some really good numbers. I think they raised their guidance as well. Certainly looks like it based on the way that the stock's performing today. It's up 10%. I think I saw it was either the top or maybe the second best performer in the S&P 500. But it hit $34, and that was right where we had topped back in November. So perhaps, well, let's see where we close. But if we struggle into the close today, I think maybe we hit a short-term top. But I think that the top of gap support close to 32 will hold on any pullback. So really good volume trends here. Nice gap up. I think the stock looks good. Nice PPO crossover there. But if we can't make the breakout above 34 on the close, then I think maybe we start to move back down closer to 32. Honestly, if the market's good, I would be a buyer down around $32. I think GLW looks pretty good.
All right. Next one is from the consumer staples sector, ConAgra, CAG.
All right, ConAgra, I don't like this at all. It's a bear flag, huge drop, massive volume. It's hardly recovered. I think probably there's another shoe that's going to drop eventually. I'm not a fan of a stock like this. Technically, what would get my attention on the long side? Well, that initial reaction high was at about 22.20 or so, maybe 22.25 here. And you can see the 20-day moving average now down around the 22 level, just below. So big volume. I'd need to see some heavy volume coming in, but a move through 22.25 on a closing basis with some serious volume, I'm going to say 10 million shares or more, might get me interested in the stock. Otherwise, I would expect it minimally to move back down to test this $20 level.
All right. And just FYI on that one, it's been going southwest on the RRG, which of course is the worst place to be going for like weeks. It's just heading straight down in there and continuing. So yeah.
Yeah, this thing was really sold off hard in December. I mean, the market was sold off hard, but this was a stock that was down about 40%, most of that in about 3 or 4 days. And with the huge rally we've seen in the market, the stock has barely budged back to the upside. That's definitely not a good sign.
No, no. Another very popular one that we haven't looked at in over a week is Square.
Yeah, Square, good company. Obviously starting to show a lot more strength again. You know, if you're bullish the market, if you don't believe we're going to go back down, if I did not believe we were going to go back down, I would buy Square on this 20-day test, because this is a company that, if you look at the long-term trend, has been an excellent performer. And so if it truly has ended this downtrend and is starting to move higher again, the 20-week moving average, by the way, is sitting at 68.60. So we're right on the 20-week moving average, and we're also approaching the 20-day moving average. This is the perfect time if you think stock goes higher. But again, I'm not really into that long mode at this point. I'm nervous about the market. I think more stocks are going to break down than are going to break out. And so I'm going to avoid it. But if I was saving the chart, I would definitely be highlighting the fact that with a strong PPO, you're coming back down, testing the rising 20-day moving average. That's where I would expect to bounce.
All right. Let's see, our only industrial that was requested, American Outdoor Brands, AOBC.
Another one not really performing very well. Big move up in December, but that was just bad timing, maybe bad luck, because the overall market probably took it down lower. I think if it can hold on to the key price support between 1150 and 1180, then I'm okay. At first, I didn't like it. After looking at it here for a second, you've got this great support here from the gap up on massive volume back in August. And then the one intraday low that went below it right here. This is the area I would view as major support. So I could make an argument that it would be okay to be long this stock here. Certainly as it weakens down closer to 1150, your reward to risk gets better and better. Top of this range would be all the way up near $16. So I think the reward to risk on this one's pretty solid.
All right, excellent. And our last one from the materials sector, Albemarle, ALB.
Another one, downtrend, bear flag, struggling at this overhead resistance. I think you got a little bit of gap resistance as well. So let's just draw those two lines in. There is your gap resistance. Look at the heavy volume gap down. So we got up to about, $79 to start the year. Now we hit today $78.72. Top of gap resistance is at 80. And, again, while the market's making this huge rebound, ALB is doing almost nothing. So I would respect this current trading range as a flag off of a downtrend. So you got a bear flag. They normally break to the downside. So until I could get a big volume move through 80, I would be bearish Albemarle.
Okay, excellent. And that completes the 10 and 10. Here are the symbols that we just went over. You will find those in the Market Watchers Live chart list, and that can be reached by just going to the blogs or articles tab and looking up the Market Watchers Live blog. Just select that on the right-hand side, and then you'll see the link right there at the top. Also, the link is in every Market Watchers Live recap, which you should take a look at if you're a regular watcher. All right, so let's go ahead. It's time for our final market update. Let's go ahead and see what is going on right now. Okay, not great, but not horrible at this point. You were, talking about a bifurcated market. Definitely today. The Dow is actually up right now, 0.3, looks like 0.3%, and it is moving higher again. It had come down and touched the close from yesterday and then bounced. I would be a little concerned maybe, though, that we have a double top coming together here, but we still would have to see it break down below and into the negative area for it to be that. But S&P 500, Nasdaq, are both down currently. S&P is down only 0.12%. Nasdaq is down 0.2%, so having a more difficult day. Mid caps are on the positive side currently, and so let's see. Russell 2000 was until just the last 10 minutes, and now it has moved to the downside, but it's only down like 0.1%. TSX is rising nicely despite what we've been doing as far as the US markets, currently hitting new intraday highs, up over 100 points. The TNX Treasury yields have been continuing their drop lower since the top yesterday, and they are currently reading at 2.722%. The VIX, you know, it has been all over the place. We did get back up to that 20.5 area yesterday, but we're just not quite getting there. We're looking at a high today of just under 20, and currently it's just over 19. So looking okay. People seem to be all right, I would guess, with what's going on in the market. UUP, the dollar, is down only slightly, currently reading 25.45 for UUP. Gold, had a nice move to the upside, but has been just consolidating sideways most of the day. Currently, GLD is up 46 cents. USO, big gap up and forming a symmetrical triangle here. Like I said, those are usually continuation patterns, could be continuing the rising trend that began yesterday at lunchtime. TLT is up a quarter, reading 120.66. And that's all I have for my part of the market update. What you got for us, Tom?
Okay, I wanted to show the relative chart, and this goes back 10 years on the Nasdaq 100 versus the S&P 500. So you can see that during this entire bull market, well, I shouldn't call it bull market anymore because technically we are in a cyclical bear or in a bear. But throughout the last 10 years, you can see that for the most part, the Nasdaq 100 has outperformed the S&P 500. That makes sense because you've got a lot of technology stocks. You got a lot of companies that tend to do better in solid economic environments or improving economic environments. They tend to grow their earnings faster. And as a result, their prices move up faster. So that's what you want to see in order to feel good about the market. You want to feel, or you want to see the NDX moving up faster than the S&P 500. And if you take a look back through history, when the NDX is above when the NDX relative to the S&P 500 is above the 20-week moving average, for the most part, the NDX is rolling along pretty good. When we stumble, like we did in late 2012 into early 2013, you can see the NDX actually has problems moving any higher. Now, keep in mind too, this is during a bull market. So if this is a bear market, a continuing bear market, then going sideways is probably not going to happen. We're probably going to go lower. But my point is, when the NDX is underperforming, that can be problematic for stocks. We saw it again back in late 2015 into early 2016 here. And you can see again, NDX could not break out, went sideways for a while. And it wasn't until we really started moving in 2017 on a relative basis that we started getting that same absolute performance to the upside. The problem is that we moved back in the start of the fourth quarter below this 20-week moving average. We are now hitting this downtrend line on the Nasdaq 100, and you can see that we're starting to roll back over again. In other words, today we talk about bifurcated action. Well, it's bifurcated, but it's not something you should ignore. The bifurcation is occurring because the more aggressive Nasdaq 100 is not being treated as favorably as the S&P 500. And as long as that's the case, we're going to have problems breaking back out to the upside. So it's definitely something to keep in mind as we move forward. Okay, I am now going to go into the final segment of the day. It's going to be scooter reports. Of course, if you are at all familiar with stock charts, you know that the scooters is something that is you can only find here at StockCharts.com. It is an exclusive feature here at StockCharts. And if you're not familiar with it, or if you haven't used it, you really should. I don't know of too many folks here at StockCharts that don't use it at all. I don't use it every day, but I certainly do use it from time to time. We talk about it on the show quite a bit, and it's that important. You should know about it. Okay, so let's take a look at, I'm just going to go in first and show you some of the things that you can be or should be thinking about in terms of the scooter. Now, the first question you might have if you're not familiar with the scooter is, what is the scooter? Because if you think about it as a kid, it's this two-wheel thing that you ride around the neighborhood. That's not what we're talking about here. We're talking about the StockCharts Technical Rank, which was developed by John Murphy. And that right there should give you plenty of comfort knowing that John Murphy came up with this particular acronym, the StockCharts Technical Rank. Again, if you're unfamiliar, all you have to do is go to that search, type in SCTR. That is StockCharts Technical Rank, SCTR. Hit go. Now, what you're going to see come up is all of the support articles, which if you wanted to go in and look for support articles on it, that's fine. You can do a couple of different things with it. You could say, okay, well, what about blog articles? Who's been blogging about about scooters? And you can see here, Market Watchers Live blog talks about it. This is, I think, Greg Schnell's blog. Yeah, there's the author. I've written about it. I wrote about it in Chart Watchers recently. But if you wanted to go to a specific article or author, let's say you wanted to look at, say, Greg Schnell. He talks about scooters a lot. So if you pull up Greg, you can see all of his articles. And you can see a ton of them here in January of 2019 where he mentions the scooter. So Greg would be somebody really good to watch and follow if you want to learn more about the scooter, because he talks about it quite a bit. Me, on the other hand, I talk about it from time to time, but not a ton. So, for instance, here in January, I've had a couple of articles where I've mentioned the scooter. December, probably as you go back each month, there's probably 2 or 3 articles per month, something like that, where I'll mention scooters. But if you just want it, and I'm going to go in and look at the Chart School article. So the Chart School article, this is where you can learn a lot about technical analysis, including things like the scooter, which is exclusive to StockCharts.com users. So here was the introduction, how you calculate it. I'm not going to go through all the calculations. One thing you should notice, though, is that 60% is based on long-term indicators, 30% on medium-term, and 10% on short-term. So if you see a stock that hasn't been doing much for a couple of years, and all of a sudden today, or maybe the last week or two, it's really exploded, it's not going to have a 99 scooter, because the longer term chart is still not going to be very attractive. And 60% of the rank is based on long term. How much above or below the 200-day moving average is it? The 125-day rate of change. So that's what a stock is doing today versus what it was doing, where it was 125 days ago. So if you got a stock that's been downtrending for a while, but all of a sudden turns up for a week or two, it's not going to score very well on these 2 long-term indicators. So in order to have a high scooter rank, you've got to have a company that's not only doing pretty well in the short term, but it has to especially be doing well in the long term. 60% of the score based on these 2 indicators. All right, so I just wanted to give you a sense. If you want to come in here and look at it in more detail, I would urge you to do so. I think it's really important that you understand the scooter, because it is a very, very quick way from a technical analysis standpoint of finding out which stocks are performing well versus their peers, and they're based on market cap. So when you're looking at a large cap stock, and if it says it's a 99.9, then essentially you have a stock that, based on the scooter rank, is better than 99.9% of all large cap stocks. That's important to know technically when you're looking at a chart. Okay, so that was the introduction, the definition, if you will. Let's go into your dashboard, because I don't know if everyone is aware that you can go down here to the technical ranks. And if you don't have this showing up on your screen, you should check this little gear box here and make sure that you have additional data panels checked. And if you do, if I take those out and I update, now they're gone. Those 3 technical scans are gone. If I add it back, not technical scans, technical rankings. So then I add it back, and there they are. Now, one thing you can do is you can see scooters under the technical ranks. I could change this, and then it would switch over to market movers, top 10. But if you check the scooters, then your choices are large cap, mid cap, small cap, ETFs, Toronto, and London. Now, I tend to use scooters large cap and put it on top up, scooters mid cap, top up, and scooters small cap, top up. Now, the reason I do it is I just like to see which stocks are making a big move. Based on those formulas I just showed you, these stocks can quickly move based on something that happened. Like we were talking about Corning earlier with earnings. Well, take a look. It's the biggest mover, scooter mover among large caps. That's, again, worthwhile to know. And all of this can be set up right on your dashboard so that you can quickly scroll through and see if any of the stocks kind of catch your attention. If you scroll over the symbols, you'll get what the charts look like. Here, LLL is breaking out today, and I think they also reported earnings. Then you've got Rockwell Automation and so forth. I mean, here's Dover. I think they beat top line, beat bottom line, raised guidance. Now they got a scooter rank, 93.8, up 29 today on their scooter rank, and so forth. So you can go right down the list. Here's your mid caps. Here's your small caps, depending on what you want to look for, or ETFs, if that's your fancy. But that's another way to look at scooters very quickly. It's all done for you. You don't have to do anything. It's just right there for you to take a look at. And if you're more into shorting, and you can look at the top up, by the way. Here's a stock, GGG, 55.3 scooter, and it's up 20. That means it was 35 before today. So it was a pretty low scooter rank. It's getting a bounce. Maybe this is getting close to a short. Maybe, that if you're shorting, there's a pretty big resistance area at about 44.5. We hit 44.12 earlier today. So even the ones that are really moving to the upside doesn't necessarily mean they're breaking out or they're healthy technically. It could be providing you an opportunity to find a short. So low scooters, but scooters that are moving up quickly could be a short-term move to the upside, which is then maybe just taking the stock to a key resistance area. Okay, let's take a look at the sector summary. So over here under member tools, if you scroll down under reports and analysis tools, you got sector summary. Notice on the sector summary, we have, that doesn't stand for sector, that's StockCharts Technical Rank, SCTR, scooter. And if we sort by that, you can quickly see which sectors have the highest scooter ranks. So real estate is doing particularly well. Look what's next. Utilities, healthcare, consumer discretionary. One problem with this, all four of those are defensive groups. The defensive ETFs or defensive sector ETFs have the highest scooter scores. That is not what you want to see, and that's not what you're typically going to see in a bull market. That is what you're normally going to see in a bear market. Go to the bottom, and you've got energy, communication services, and technology to the downside. So the XLE, XLC, and XLK really poor scooter scores relative to their other ETF peers. So that's just a very, very quick way of identifying what is working in this market and what is not working, what has not been working. So let's say, okay, I'm on the long, or I want to be on the long side. Well, chances are you might want to think about the real estate group because it has been technically one of the better areas. And knowing that the market is kind of in this cyclical bear market and could be rolling back over again, real estate on a relative basis should outperform in that scenario. So not only has it been a leader in this bear market, but if we do roll over and start to move lower again, I think this is a group. If I was going to be on the long side, I think these are the types of stocks that I would be interested in. So let's say, okay, now I'm committed to the real estate sector. What do I do? Well, let's go back to the dashboard again, member tools, go down to that same area, reports and analysis. And right beneath sector and industry, look what we have, scooter reports. So if I pull up the scooter reports, let's say, okay, I'm going to stick with the large cap. I could do large cap, mid cap, small cap, ETFs, Toronto, London, and India. I'm going to stick with large caps here. Let's say I just want to be safer. And it's in scooter rank order, but and you could look down and say, okay, well, I want to find the real estate. Okay, here's a real estate stock, Welltower. Let me find another one. Here it is. Well, an easier way is to come into the search table and just type in real estate. And all of them come right up in order. And here are your scooter ranks. So now I could quickly take a look. There's one breaking out. HCP breaking out. AIV breaking out. O breaking out. UDR breaking out. See how quick and easy it is? Going from scooters, just taking this basic information and going through, if you know where to find everything on stock charts, how quickly you can zero in on stocks that are performing extremely well and have those high scooter ranks that you're looking for. Now, if let's say you wanted to move to energy because that's got the lowest, let's say, oh, I'm interested in the shorts. Well, energy, and you click on the scooter again, it'll start from the bottom and give you all the energy. So now you can see all the stocks that have been underperforming if you're more on the short side. APC, look at the downtrend, DVN, EQT, BHGE, NOV, and so forth. So very quickly, I mean, there's so many tools at your disposal, and we talk about the scooter ranks a lot here on Market Watchers Live. Again, you can go in and you can search by blog author. Greg Schnell, I know, is one who mentioned scooters a ton, and he's been on the show quite a bit. I know he subbed yesterday for me, and Arthur subbed for me last Thursday, and of course Friday, What's Hot, What's Not with Mary Ellen. I want to thank them all for helping you out, Erin, and on the show. But it is amazing how much information we have on the site and how quickly you can access it.
Yes, absolutely. And that's, you know, and they keep making it easier and easier. I mean, if you click on that charts and tools tab, you can find a lot of those on the, just up at the top, the new, yeah, there you go. And then if you go to the right, you can just easily arrow down and look for summary pages and all of the reports and such just on the right.
Yep. Yes, you can.
Made it easier.
Yeah, yep. And there's a lot of really good information. I know in the past there was a lot of good information on the free pages, and a lot of our subscribing members never looked at it. Make sure you go through that charts and tools, this charts and tools page that I showed you just a couple minutes ago, because it is enlightening. A lot of good information there. But here, just to recap what I went over on the scooter report, you can see there. Go in and read that article. If you haven't done so and you want to learn more on the scooter rank, you will know so much more after reading that article. And, you know, don't get so caught up in the percentages if you're not really into the math side of it. Just understand that the long-term picture really matters with the scooter. 60% of the scooter score is going to be based on some of those longer-term indicators. Only 10% based on the short term. I know you were looking, Erin, for the S&P to get up to about that 2,600. We went a little bit above it. I was initially looking for 2581, but also I had kind of given a range of up to that 20-week moving average at 2670 or wherever it is right now. But it seems like short term, we're just stuck here in a pretty tight range. Every time we move lower, it seems like the market, we get buyers coming back in. But I'll be honest, I'm a little nervous after seeing the number of reports beginning to pick up and seeing how many companies are lowering their guidance. I'm a little nervous about this market. If we lose price support, I'd be real careful.
Right. And who knows what's going to happen tomorrow after the Fed announcement. I mean, that has been making the market pretty volatile.
Well, I mean, what do you hope for? I guess you hope for the Fed to be accommodating and to kind of be like the old Fed, where anything goes wrong, we're going to jump in and we're going to bolster the market. I think that Jerome Powell's trying to get away from that, honestly. I don't think he wants to be known as the one that's going to prop up the stock market every time it needs it.
Right.
So tomorrow could be interesting, no doubt. I agree with you. All right. Want to thank everybody for joining us today. We do appreciate you supporting us here at Market Watchers Live. Please remember to complete the survey as you exit. It's located below the video player. We'd love to get your feedback, hear what you think of Market Watchers Live. Let Erin know what you thought of her presentation today. I'm sure she'd like to hear. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. Up comes Apple after the bell. We'll see you back here tomorrow. Happy trading.
Is your portfolio positioned to profit from continued market volatility in 2019? Join over 100 investing and trading experts, including policy guru Steve Forbes, emerging markets icon Mark Mobius, America's best income investor Bruce Johnstone, elite energy analysis Stephen Schork, and trading visionary Tom Sosnoff at The Money Show Orlando to get the best ideas for protecting and growing your investment portfolio during 250 in-depth presentations. Claim your free pass now at orlandomoneyshow.com.